there is a version of Italy that lives in the global imagination, the version with the ancient piazzas, the world's greatest concentration of Renaissance art, the fashion houses and the Michelin-starred trattorias, the country that gave Western civilization its architecture, its legal tradition, and its idea of what a beautiful life is supposed to look like. For decades, tourists have arrived in Rome, in Florence, along the Amalfi Coast, and returned home believing they had seen one of the most extraordinary places the modern world has to offer. They were not wrong, but they were also only looking at the surface. Underneath that postcard is a different country entirely, one carrying a debt pile so large it defies the logic of repayment, one whose banks are quietly failing, one whose workforce is shrinking faster than at almost any other point in its post-war history, and one whose political system has demonstrated repeatedly that it is structurally incapable of fixing any of it. The world watched Greece in 2010 and called it a crisis. Greece was a warning shot. Italy is the main event, because Italy is not Greece. It is 10 times the size. It is the third largest economy in the Eurozone. It is too large to be rescued, too connected to be abandoned, and too broken to rescue itself. If you are Italian, or if you live in Italy right now, tell me in the comments what you are actually seeing on the ground. Because what the data is showing is a country running out of time. Every few years, the Eurozone faces a crisis, and every few years the same playbook gets pulled out. A country overspends, bond yields spike, Brussels intervenes, austerity gets imposed, and the worst of the damage gets quietly absorbed by the European Central Bank. It happened in Portugal, it happened in Ireland, it happened most visibly in Greece. And each time, the architects of the European project pointed to the resolution as proof that the system worked. But that playbook was written for small economies. It was never designed for Italy. Greece, at the peak of its crisis, represented roughly 2% of Eurozone GDP. The bailout was politically painful and economically brutal, but it was ultimately a problem the rest of Europe could afford to solve. Italy is a fundamentally different calculation. It is the third largest economy in the Eurozone, accounting for nearly 15% of the bloc's total output. Its national debt, measured in absolute terms, is the third largest in the world. The exposure of European banks, particularly French and German institutions, to Italian sovereign debt is so deep that a disorderly Italian default would not be a local emergency, it would be a continental one. This is the distinction that makes Italy uniquely dangerous. Greece was a country that needed saving. Italy is a country that cannot be saved in the same way, because Italy is too big for the lifeboat. The numbers that got smaller countries through their crises simply do not scale to Italy's size. And the 6 warning signs we're about to go through are not independent problems. They're a system of interlocking failures, each one making the others worse. Italy's national debt currently sits at approximately 2.7 trillion euros. That number alone is striking, but the number that matters is the ratio. At roughly 140% of GDP, Italy owes more relative to the size of its economy than almost any advanced economy on the planet, exceeded only by Japan, which carries a set of structural advantages Italy does not have. What makes this particularly damning is not the size of the debt in isolation, it is the trajectory and the economic environment surrounding it. For the debt to stabilise, let alone fall, Italy would need 2 things to happen simultaneously. Its economy would need to grow faster than its borrowing costs, and its government would need to consistently run primary budget surpluses, meaning it would need to collect more in taxes than it spends before interest payments are factored in. Italy has failed both of those conditions for most of the last 20 years. GDP growth has been, by any reasonable measure, catastrophically weak. Between the early 2000s and the end of the 2010s, Italy's economy essentially did not grow in real terms. Productivity stagnated, private investment dried up, the debt meanwhile kept compounding. The result is a country paying an increasingly unbearable interest bill simply to service existing obligations, with no credible path to reducing the principal. Every year the debt grows, the math gets harder, and every year the math gets harder, the banking system holding that debt becomes more fragile. Which brings us to the second warning sign, and this one is where the quiet fear inside European financial institutions actually lives. The relationship between Italian banks and the Italian government is one of the most dangerous feedback loops in global finance. It works like this. Italian commercial banks, seeking relatively safe and liquid assets, buy large quantities of Italian government bonds. The government in turn depends on that steady domestic demand to fund its debt at manageable interest rates. On the surface, this looks like a stable arrangement. Beneath it, it is a trap. When confidence in Italy's fiscal position falls, the market value of those government bonds falls with it. The banks holding those bonds see their balance sheets weaken. Credit conditions tighten, the economy slows, tax revenues fall, the government's fiscal position deteriorates further, bond prices fall again. This cycle, which economists call the sovereign bank doom loop, has no natural stopping point. Each turn of the wheel makes the next turn more likely. Italy entered the modern era of this crisis already carrying an enormous stock of non-performing loans, debts that borrowers have stopped repaying, that burden bank balance sheets and constrained lending to the real economy. While some of those loans have been written down or offloaded in recent years, the underlying vulnerability was never resolved. The banks are cleaner than they were a decade ago, but they are still deeply entangled with a sovereign borrower whose creditworthiness is deteriorating. They cannot escape Italy's fate because their assets are Italy's fate. And the banks are not the only institution running out of options. The population funding the entire system is shrinking in ways that no bailout can reverse. Italy is aging faster than it can compensate for. The fertility rate has been below the replacement level of 2.1 children per woman for over 4 decades. It currently sits closer to 1.2, one of the lowest in the developed world. The population that does exist is aging rapidly, with median age figures that place Italy among the oldest societies on the planet, and the young Italians who do exist are leaving, brain drain from southern Italy northward, and from Italy outward into Germany. The United Kingdom and beyond has been accelerating for years. Stripping the workforce of precisely the educated, productive workers, the economy most needs to generate growth. The fiscal consequence of this is not abstract. Italy's pension system is extraordinarily generous by European standards, the product of decades of political deals that prioritise retirement benefits over long-term sustainability. The country spends a larger share of GDP on pensions than almost any other developed nation. That bill is being paid by a shrinking base of working-age taxpayers. The ratio of workers to retirees is declining year by year, meaning each worker is carrying an increasing share of a fixed and growing pension obligation. There is no technical fix available at the scale required. Raising the pension age creates political crises. Cutting benefits triggers street protests. Importing workers at the pace required to rebalance the ratio would demand an immigration policy that successive Italian governments have explicitly campaigned against. The math of Italy's demographics does not bend to political will, and when you understand what's waiting for us in the next 2 warning signs, the full weight of that statement becomes clear. Every expert who has studied the Italian economy agrees on the diagnosis. The country needs structural reform. It needs to modernise its labour market, simplify its tax code, digitise its public administration, accelerate its civil justice system, and reduce the regulatory burden that makes doing business there among the most complicated in the developed world. This consensus has existed for decades. The reforms have not followed, and the reason is not a mystery. Italy has had more than 60 governments since the end of the Second World War. The country's political architecture, built on proportional representation and deeply fragmented party systems, produces coalition governments of extraordinary internal instability. Parties that agree enough to govern together rarely agree enough to legislate the painful, structural changes that economists recommend, because those changes create losers, and in Italian politics, every group of potential losers has a coalition partner willing to block reform on their behalf. The civil justice system compounds this. Italy has one of the slowest court systems in the developed world. Contract disputes can take a decade to resolve. This is not an inconvenience for business. It is a structural deterrent to investment. Firms that cannot rely on courts to enforce contracts rationally avoid making long-term commitments in the Italian market. Investment flows to places where the rules are predictable and disputes are resolved quickly. Italy has been losing that competition for a generation. Every reform program announced by every Italian government in recent memory has stalled, been reversed, or been quietly abandoned when the coalition calculus shifted. The structural rigidity is not incidental. It is the system operating as designed. Italy built one of the most distinctive industrial economies in the world. The country became synonymous with precision manufacturing, luxury goods, fashion, design, and the kind of high-skill artisanal production that exports at a premium. That model worked exceptionally well in the second half of the 20th century. In the digital economy of the 21st century, It has become a structural liability. The problem is not that Italian industry is bad at what it does. The problem is that what it does is increasingly insufficient. The global economy has shifted towards software, platform businesses, artificial intelligence, and technology-driven services. Italy has no meaningful presence in any of those sectors at scale. The country has produced no global technology champions. Its startup ecosystem remains underdeveloped relative to its economic weight. Research and development spending as a share of GDP consistently trails the European average. Meanwhile, the talent that might build those businesses is leaving. Italian universities produce highly educated graduates who face a labour market offering poor starting salaries, limited career mobility, and a professional culture that rewards seniority over merit. The rational response for an ambitious young Italian professional is emigration, and hundreds of thousands have made exactly that calculation. The brain drain is not a temporary correction. It is a self-reinforcing spiral. The more talent leaves, the weaker the innovation ecosystem becomes, and the weaker it becomes, the more talent leaves. Italy is watching its industrial base slowly become obsolete, while the people most capable of building what comes next are building it somewhere else. And what happens when you combine that internal weakness with shocks arriving from the outside? That is where warning sign 6 closes the trap. Italy sits at a geographic and geopolitical intersection that makes it uniquely exposed to the instability now permanently embedded in the global economy. The country has historically been one of the most energy-dependent major economies in Europe. It imports the vast majority of its natural gas, and for decades ran deep energy relationships with Russia and North Africa, arrangements that provided relatively cheap supply but concentrated risk in precisely the wrong places. The fallout from Russia's invasion of Ukraine exposed that vulnerability in real time. Energy prices spiked. Italian industrial competitiveness, already thin, came under acute pressure. Manufacturing sectors that depend on energy-intensive processes faced cost structures that made competing with Asian producers nearly impossible. The government was forced to absorb enormous fiscal costs to protect households and firms from the full impact of the price shock, costs that landed directly on a public balance sheet already stretched beyond its limits. The structural exposure did not disappear when energy prices partially stabilized. Italy's supply chains for critical inputs remain fragile. The Mediterranean trade routes on which it depends are increasingly contested. The country's geographic position, which once made it a natural hub connecting Europe to Africa and the Middle East, now places it on the front line of migration pressure, energy disruption, and regional instability simultaneously. Italy cannot insulate itself from these shocks through domestic policy, and it cannot finance the buffers required to absorb them. It is exposed to a world that has become more volatile, without the fiscal capacity or political coherence to build resilience. For much of the decade following the European sovereign debt crisis, Italy was kept functional by one mechanism above all others. The European Central Bank under Mario Draghi and his successors suppressed borrowing costs across the Eurozone through quantitative easing and a series of bond-buying programs that effectively placed a floor beneath Italian debt. The market knew the ECB would not allow a disorderly spike in Italian yields, and that knowledge itself kept yields from spiking. It was a guarantee that cost the ECB enormous balance sheet expansion, but bought Italy time, which it failed to use productively. Then inflation returned. The ECB, whose mandate is price stability, had no choice but to raise interest rates aggressively and to begin unwinding the asset purchase programs that had suppressed Italian borrowing costs for years. The spread between Italian and German government bonds, the financial market's primary gauge of Italian risk, widened immediately. The relief valve closed. The consequence is mathematical and direct. Italy must refinance hundreds of billions of euros in maturing debt every single year. As that debt rolls over at higher interest rates, the annual interest bill grows. A growing interest bill on a stagnant or shrinking economy with a fragile banking sector and a deteriorating demographic base leaves progressively less fiscal space for anything else. Education, infrastructure, healthcare, the social programs that hold a society together under stress. Each percentage point increase in refinancing costs tightens the trap. The ECB bought Italy a decade. What Italy is left with now is a debt burden that is actively compounding, and a set of options that were never good and have only become worse. At the centre of all of this is a structural flaw that no Italian government can solve alone. because it was built into the architecture of the Eurozone at the moment of its creation. When Italy adopted the euro, it surrendered its monetary sovereignty. It gave up the ability to set its own interest rates, to manage its own money supply, and most critically to devalue its currency when its economy fell out of competitive alignment with the rest of the bloc. Currency devaluation is a blunt instrument. It reduces living standards in real terms for the population. But it also restores export competitiveness, reduces the real burden of domestically held debt, and gives an economy in distress a mechanism for adjustment. Italy used that mechanism repeatedly across the post-war decades. The Eurozone removed it permanently and replaced it with nothing equivalent. The system that replaced it was optimized for economies that were already structurally similar to Germany. Fiscal discipline was assumed. Productivity convergence was projected. Neither happened. Instead, the gap between the Eurozone's strongest and weakest members has widened over time, and Italy has found itself in a monetary union that cannot flex to accommodate its specific trajectory. The binary choice approach to Italy is not a theoretical construct. It is an arithmetic reality. The debt will either be restructured, in some form, at enormous cost to European creditors, or Italy will be forced to pursue austerity of a severity that historically produces social and political disintegration. Neither outcome leaves the European financial architecture intact. Neither outcome leaves the euro unchanged. The question is not whether Italy will force that reckoning. The question is how much time is left before it does. If you want to be in the room when those stories break, subscribe. There is no algorithm that will reliably surface this kind of analysis to you. The only way to make sure you see it is to be here directly. And if this video made you reconsider something you thought you understood about Europe, about debt, or about the limits of monetary union, share it with someone who is still looking at the postcard.